While economic news lately has largely been negative, inflation at the last we heard remains high. The economy contracted for a second quarter. Russia's invasion of Ukraine continues. Supply chain issues remain. The stock market, though, could have its best month of the year. Economists always say the stock market is not the economy, and here to explain just how that might be true is Sandy Wiggins from ACG Wealth Management. Sandy, thanks as always for coming in.
Yeah, my pleasure to be back.
So there was just a ton of bad negative news from the start of the year, and then of course with the Russian invasion of Ukraine, it just kind of piled up. What were some of these headwinds that we've been facing all year?
You know, it really goes back to the beginning of the pandemic, where the Federal Reserve, lowered interest rates significantly, pumped a lot of cash into the economy to push things along, and the outgrowth of the pandemic was a breakdown in manufacturing and the supply chain issues. And those two things came together and created the inflation wave that we saw at the beginning of the year that really took the stock market down.
Right, because you had all the stimulus money that was out there, all this like pent up cash in a sense, and then not enough goods. And so then all of a sudden inflation. I mean, inflation was really all we've been talking about for the last few months. Every time you drove past a gas station, you saw that. But that seems to have subtly changed. I mean, even we were talking earlier, in early July, 2 weeks ago, the numbers for June came out in terms of the consumer price index. Terrible, 9.1%, the highest it's been in 40 years. But something happened since then.
Well, the CPI, the consumer price index, is a rear view mirror, so to speak, on what's going on. And so June was a terrible month with inflation. But what we've seen since then is really a drop in most commodity prices, with the exception of natural gas. Corn's down, wheat's down, oil is down, and now the consumers hopefully are seeing that, and that'll translate into more spending.
And we've been talking about that here. We put the prices up daily. Oh, it's down 60 cents over the last 2 or 3 weeks or so, and people are saying, yep, now down below $4 as far as gas goes. But you're also pointing out that corn and wheat have dropped 20 to 35% since those numbers came out. And the stock market since that day is up 6%, the S&P, 7% for the NASDAQ. It's looking forward, you say, which is why you were at pains to say, remember, the stock market is not the economy. Tell me about that.
Yeah, the stock market is really a collective estimate of what's going to happen 6 to 9 months from today. And so even though we have an economy that is slowing down based on the recession number we got today, the Fed is continuing to raise interest rates to fight inflation, but the market is anticipating a slowing of those rate increases by the Fed, and perhaps even rate reductions in 2023. So if all that comes together, that soft landing that we sometimes hear about indicates that maybe it's not as bad as the market had priced in earlier this year. Hence, nice returns in the stock market during the month of July.
Well, in the last week or so, I've heard several young colleagues here talking about, hey, with all this, bad stuff happening economically, should we be changing our allocations in our 401k? And my ears perked up, and I thought, you know what, I got to talk to Sandy Wiggins about that, because the whole point of the way you allocate is to ride through the ups and also the downs.
Yeah, you want to build a portfolio that you can really stick with and weather through the good times and bad. And if we think about some of the news that I'm sure you reported at the end of June, was that it was the first time since 1970 to have a terrible start of the year. Well, the second part of 1970 turned out to be great. I'm not saying that's going to happen here, but it's another reason why you don't want to be monkeying around with your portfolio in the middle of all this, because likely you're going to be making a mistake at the wrong time.
And getting out when things are cheaper. Sandy Wiggins from ACG Wealth Management, thank you, sir, for your expertise as always.
Yep, thanks to be here.
All right, let's